Hello, this is Prof. Aram, and in this video, I will go over the liquidity ratios and focus on the importance of this group of ratios. So let's get to this. I want you to know that troubled companies usually go bankrupt because they run out of cash. So liquidity ratios measure this risk by focusing on the ability of the firm to meet its short-term obligations with the assets that can be turned into cash quickly. If you remember from the balance sheet video, current assets are the most liquid assets for the firm. These are the type of assets that the firm can turn into cash, hopefully within the year. And then current liabilities, on the other hand, are the types of liabilities that need to be met, need to be paid within the next year. So we're looking at the ability of the firm to be able to pay off these current liabilities using the current assets that they already have. When you look at these liquidity ratios, think about this. Who wants to see a very high liquidity ratio and who doesn't like that? In the first case, of course, banks and suppliers like to see a very high liquidity ratio because they want to make sure that they get paid on time. For example, in terms of suppliers, want to make sure their customers can pay them on time. The key to think about here is that if the supplier is going to extend credit to the firm, and if a firm will be able to survive in the next 6 to 12 months. What about shareholders? Do they like to see a very high current ratio or low current ratio? Do they want to see a high liquidity ratio or low liquidity ratio? A high liquidity ratio introduces a trade-off for the shareholders. They don't want to see a company go bankrupt, so having enough liquidity is important. But at the same time, they don't want the company to hold huge amount of liquidity, huge amount of cash, because the thing about cash is that it's not earning high returns. I mean, sometimes if the company don't invest those cash in marketable securities, it earns zero return. And in fact, in high inflationary environments, that cash is losing value over time. So shareholders prefer the company maintain a reasonable amount of liquidity, a reasonable amount of cash, and then invest the rest of it. If they don't have anything to invest in, they need to return that cash to the shareholders so the shareholders can invest that cash into other equally risky companies. Having a very high level of cash ratio is not really desirable from the point of view of the shareholders. In fact, if the company has too much cash, they may attract institutional investors or activist investors that can force the company to disgorge the cash and pay the cash back to the shareholders. For example, Apple at some point in I think it was in 2017 or 18, they were sitting on $220 billion in cash. So some activist investors bought the shares of Apple and forced the company to disgorge the cash, to pay out dividends, to repurchase the shares, to return the cash to the shareholders because they could use the cash to invest in other opportunities. Now, this is a good ratio to look at, but a better ratio to look at is a quick ratio. In the quick ratio, you are subtracting the inventory from the current assets of the firm. Generally, one might think of inventory as an operating asset. But to finance people, inventory represents risk that needs to be financed. Inventory can be very risky, especially if you're in a type of business that your inventory can go obsolete faster than the rest of the firms. For companies with high inventory risk, quick ratio provides a strict measure of liquidity. So if you really want to see how liquid the firm is, you need to calculate the quick ratio, which basically focus on cash and accounts receivable and extract the inventory from the current assets. This is a true measure of liquidity for the firm. So let's look at an example here. For each of these firms, which ratio would you prefer to see? Rio Tinto, which is a mining company, United Steel, which of course produces steel for car manufacturers and other appliance manufacturers, and then Louis Vuitton, which is produces fashion like handbags and clothing and stuff like that. So in case of these two, these are commodities. And usually we have a secondary market for commodities. You can buy and sell like iron ore or steel in these commodity markets like Chicago Board of Trade. But for clothes and handbags, there is usually no secondary market, or there is no spot market for that. So for these companies, which ratio do you think makes sense to look at? Of course, for Rio Tinto and United Steel, their inventory is not very risky. They can always sell the iron ore or other raw material that they have, or they can always sell the steel. I mean, what I'm trying to say is that the iron ore or the steel, they don't go bad as time passes. They don't go out of fashion as time passes. So the inventory is not that risky for these companies. But for Louis Vuitton, if they're not able to sell that handbag or the hat or whatever they're selling, if they're not able to sell that this season, they may go out of style in the next season. The inventory for Louis Vuitton is extremely risky. So for Louis Vuitton, I would rather see a quick ratio compared to current ratio. Knowing the business of the company is also very important in determining which of these two ratios is going to be more useful. I hope you find this video useful, and thanks for watching.